I think a lot of my viewers are familiar with the concept of active and passive, but for those that are joining in for the first time, for the new investors, could you break it down for us? What are active mutual funds and what are passive mutual funds?
Alex, good evening, and thank you very much for having me on your show. So, to summarize what are active and passive funds, active funds are nothing but actively managed by a fund manager. Uh, the portfolio is churned by the fund manager. So, based on the fund's category, the stock and the sector selection and its allocation is decided by the fund manager itself. A detailed analysis is done by the AMC's investment team of what and when to buy, sell stocks and its allocation. So overall, active funds are nothing but which are actively managed by fund managers. Now, passive funds are nothing but index funds. They replicate and mimic a particular index. Popular indexes are very well known like Nifty 50, Sensex, Nifty 500, mid cap, small cap, etc. So these indices are nothing but top 50 stocks by market capitalization or top 30 stocks by market capitalization, etc. Now, uh, within the passive side, these are all traditional indices. Now, within the passive side, also there is something called as the new age passive funds called as smart beta. See, these are nothing but modified index funds based on multiple algorithm formulas based on certain themes of that index. So popular in smart beta funds include low volatility, Nifty quality index, Nifty momentum, and Nifty value index.
Okay, fair point. But we often have this conversation, Rushabh, about whether you should go active or whether you should go passive. A lot of people are proponents of a combination of the two. Why are we talking about this right now, though?
See, passive funds actually came more into the limelight and have increasingly been introduced in the market after SEBI's recategorization of active mutual funds categories back in 2017, 2018. So initially, before 2017 and 2018, mutual fund categories did exist, but proper definition of these categories was not specified. I'll give you a small example for your viewers. So after this recategorization, say for example, the large cap category after the recategorization, minimum 80% of the portfolio needs to be invested in the top 100 stocks by market capitalization. The rest 20% can be invested in mid and small caps, but minimum 80% has to be invested in the large cap segment. Now, similar with mid and small caps, minimum 65% needs to be invested in mid and small cap companies, and rest can be maneuvered between large caps and stuff like that. So initially, what used to happen was, fund managers, because these rules were not specified, these limitations were not there. Fund managers could actually, venture outside these ranges and take higher allocation. For example, in mid and small cap companies, specifically in the large cap segment. So, this actually helped the fund managers, generate higher alpha, higher outperformance, but at the same time, making these funds, not true to their label. So the reason why we are talking about and discussing about active versus passive, because a lot of active funds in many of these categories are unable to beat their respective indices and have been consistently struggling to outperform. And SEBI's recategorization is one good reason for this, Alex.
Okay, let's talk about the performance of some of these active funds then. In that, could you give us a little bit of a sense of where things stand? And we can look back, I think, at the last 5, 7 years to even get some more clarity because the data shows up, I think, quite interesting trends, right, Rushabh?
Correct. Yes. So active mutual funds is a very big segment, Alex, consisting of many categories. Today I will discuss about three popular categories, importantly, which is large cap, mid caps, and small caps. So currently, the scenario doesn't look very good in the large and mid cap segment. So I'll just give you and your viewers some data. So on a point to point returns basis, as on 29th of July 2022, 92% of large caps have underperformed the Nifty 50 TRI index over the period of 5 years. Now, similarly, over the period of 7, 10, and 12 years, 96%, 60%, and 64% of active large cap funds have underperformed Nifty 50 TRI index. Now, when we compare this with the Sensex TRI, the scenario gets even more worse, unfortunately. Coming to the mid cap segment, on a 5, 10, 7, and 12-year return basis, 68%, 95%, 68%, 44% of the active mid cap funds have underperformed the Nifty mid cap 150 TRI index. Now, mid caps are still comparatively better in terms of delivering performance, but currently the mid cap segment does not look that great. But Alex, you'll be very surprised to know that the small cap segment has done phenomenally well. On a 10 and 12-year return basis, only 8% and 9% respectively of small cap funds have underperformed the small cap 250 TRI index. So small cap funds have done extremely well. The managers have able to generate alpha and outperformance in these small cap segments beautifully well.
Because that's the true skill that comes into play for the small caps, especially because the difficulty of gathering data with some of the smaller companies and projecting earnings, of course, is something that comes into play. But for the mid cap and the large cap space, Rushabh, what is leading to that underperformance?
Oh, so there are quite a lot of reasons over here. Now, number one reason what I can think of is limited space for stock selection and allocation, especially in the large cap segment, because your universe is within a minimum 80% is within the top 100 stocks, by market cap. Also, second point, it's very important that the introduction of TRI index, that is the total return index. Now, what this means is initially, dividends were not included, while in calculation of these indices. Now, with the TRI index, dividends declared by the companies, are now included. So this has actually narrowed down the gap, of returns between the funds and the indices. So with the TRI indices, returns of the benchmark have inched up anywhere between 1 to 2.5%. Another reason what I can think of is, over diversification. We all know that over diversification kills, or brings down the optimum returns, faulty allocation towards the right stocks, wrong cash calls, lack of portfolio churn. This is also something very important viewers need to understand, because indices are momentum based, price momentum and market cap momentum based. So if the portfolios of active funds are not churned appropriately and frequently, the funds can have this underperformance and lack of alpha generation. Also, another point is, high expense ratios. Active funds on an average, charge anywhere between, say, like around 2.5%, at the category average level. And index funds are usually 1% and less than 1%. So, these are the few reasons what I can think of which has led to drastic underperformance in the active segment, Alex.